Welcome back. I think this is recording. Welcome back to QAV TK. It is episode 827. It's the 8th of July, 2025.
I got a full talk on Plenti Group. You heard of it?
PLT.
PLT, that's right.
I have. They've, pretty sure I've bought them. I own them.
Okay.
Let me see. PLT, yeah, I own them in two parcels in the same live portfolio. Had them since May of this year, so not that long. One's up 6%, one's up 5%. So is this going to be a pulled pork blessing today, Tony?
Oh, I think so. Depends. Well, hang on.
Great.
I haven't received the simony yet, so we'll see. I'll assume it's coming.
Okay, yeah. Yeah, you got to get a jail free card from me, Tony. It's just, do whatever you want.
No, fantastic.
I'll help you bury the bodies, Tony. Just,
Are you a Winston Wolf, are you? It's like I call you at 6 o'clock in the morning. Got a problem here.
Yeah. Gentlemen, I work fast. I can't remember the line. I used to know that line off the top of my head. Now I can't remember it. It's a good line.
I love that scene.
Right,
I love that scene where Winston's in a casino wearing black tie at like 4 a.m, walking around, making sure all the patrons are okay. Yeah. And then gets the call.
Yeah.
I
saw Harvey Keitel he was the first person that I think the only person I've seen who came out and did like an obit for Michael Madsen.
I've seen plenty.
Talked about.
Yeah, right.
Yeah. Has Tarantino said anything?
Yeah, it was just a post.
Right.
I forget what, but yeah, pretty anodyne stuff. And I saw a clip from Letterman with Michael Madsen being interviewed, and I couldn't tell whether David liked him or not, because Madsen's just sort of sitting in the chair, really coolly, not really sort of half participating in the conversation, and Letterman goes, "You could have worn a tie tonight, and Madsen kind of he's got like 3 buttons undone, scratches his chest. Everyone goes wild in the audience. Letterman goes, "You just did that for ticks, didn't you?"
He's trying to get a rise out of him, and Madsen's just being super cool.
Correct.
Yeah. He was very cool. Yeah. Very, very cool guy.
Okay, Plenti Group.
All right.
Pretty cool company from what I can see.
Michael Madsen cool?
Maybe. Potentially.
Okay.
Yeah, they're pretty cool.
All right.
So
we'll find out.
Yeah, well, they claim to be the largest fintech lender in Australia. So straight off the bat, I'm like going, I don't know if that's the case, because Pepper Money, which is on the top of our buy list, is about 4 times the market cap size. So I'd say they'd be bigger, and they're a fintech lender. But what they might be is maybe the claim relates to them being the largest P2P lender. P2P. So interesting business model. P2P lending means that you can invest with them or you can borrow from them. So their website has 2 sides to it. You can go in and choose whether you want to give them your money and then receive an interest payment on a regular basis. So basically you're the lender, or you can go in and borrow money for whatever use you want to use it for. And probably their businesses in terms of the lending side is around 3 types of loans. So normal personal loans, but then they also offer automotive loans and renewable energy loans, which I thought was interesting. And they do it quickly. They run an online credit check on the person, and they tend to approve loans to very creditworthy borrowers. So it happens quite fast in that circumstance. And they claimed in their latest results they're now starting to use AI to improve the creditworthy checks on those online approvals. But interestingly enough, they of their automotive loans, a lot of those loans are going to electric vehicles. And they actually have a relationship with Tesla in Australia to provide loans, or some loans, for people who are buying Teslas. And I thought it was interesting. They're doing a lot of work with batteries at the moment. So large part of their loan book is going to people who are putting solar panels on their homes and buying batteries. Buying batteries and using the Plenti Group loan to fund it. So interesting sort of business. Um, their loan loss rate is 1.1%, and it's been flat on prior years. So that's probably higher than the banks because the banks are running mortgage books, but that's still pretty low and pretty flat. And on the lending side, if you're worried about losing 1% of your capital, they actually have a provision fund. So you pay an establishment fee that you get back at the end of your loan term. But if someone does default, they'll take from the fund to make you whole again. And they claim that that Plenti has always had a 100% track record of protecting investors, but it's obviously not an absolute guarantee if the loan defaults rise a lot. But yeah, interesting model, I thought. It's true peer-to-peer. Well, I shouldn't say true peer-to-peer. I think they do to bolster their loan pool, issue bonds into the market from time to time as well. But yeah, if you're speaking of retirees, as we were before, if you're in the market wanting a secure dividend, at least loans to cars and batteries are going to be secured by the underlying asset, which means if someone does default, then Plenti has the right to go in and repossess. So in that case, you are getting your money back. Personal loans, not as easy because sometimes people use those for renovations or holidays or whatever, but probably 2/3 or so of the loan book is secured. They originally were founded in the UK, but then came to Australia in 2014. Founded in the UK in 2010 as a peer-to-peer lender, came to Australia in 2014. Established locally here, listed here, and yeah, they've gone from there. But if you look at their numbers over the last 5 years, they've both in terms of their loan pools and in terms of their revenue, they've had something like a 6-fold increase in those two metrics over the last 5 years. So at least recently, they're starting to see very strong growth in this market. And the results for the last year were pretty good. So their year end is 31st of March 2025. So it's one of the things on the buy list which we can use the most recent numbers for. And that's, I guess, a heads up for people going into reporting season, which is coming up next month, that the numbers for companies with a June end date are now getting 5 or 6 months old. So just be aware of that and factor that into your considerations. But these ones are only a month old. So, sorry, I shouldn't say that. They would have come out, March end date would have been May, would have been their reporting period. So they're a couple of months old. Anyway, total loan portfolio for the last 12 months was up 19%, revenue up 23%, and full year NPAT more than doubled on the prior year, up 126%. They reduced their cost to income ratio from 26.5% down to 23.9% in the latest results. And they're claiming that's evidence of the operating leverage inherent in their technology-led business model. And just to compare and contrast, CBA's cost-to-income ratio was 45%, or is 45%. So big difference to the traditional banks in their cost structures. Likewise with net interest margin. So net interest margin, another metric I like to track for banks, was 5.3% and was up 14 basis points compared to CBA with a net interest margin of only 2.08%. So big difference by being online only. Couple of things that have happened for this company recently. So in June, they've announced that the West Australian government has got them involved in running the West Australian residential battery scheme. So Plenti is using its technology to providing a simple application and management portal for accredited vendors, allowing households to access both the rebates and financing in one simple experience for their batteries. And the West Australian government is providing very good incentives and rebates to buy batteries at the moment. And Plenti's facilitating that scheme. Obviously, they get the benefit of people taking out a loan to buy the battery, even after rebates. And then also in the last little while, Plenti and NAB have announced a strategic partnership. So under the partnership, Plenti provides NAB powered by Plenti car and electric vehicle loans and makes Plenti brand renewable energy finance available to NAB customers. So that launched in the second quarter in 2025, so last year, but it's been ramping up and it's had quite a large increase in the last quarter of people taking out loans through the NAB powered by Plenti platform. And the other thing to mention in terms of recent news is that they transitioned their CEO. So Adam Bennett, who is ex-NAB actually, so he perhaps was behind that title, he joins as CEO, and one of the co-founders, Daniel Foggo, transitions to a non-executive director role. So seems to be a successful transition based on the latest results. QAV numbers for this company, and I hasten to add, average daily trade for this company is only $59,000. So it's small, even though it has been growing over the last 5 years. It's only going to suit small portfolios, or at least a small position in the larger portfolio. Share price for analysis was 91.5 cents. Interestingly enough, that's only 70% of the consensus target. It's above IV1, which is $2.03, but below IV2 of 31 cents. It's well above book value, which is 24 cents per share, so we can't score it on that. Company isn't paying a dividend, so we can't score it on that. Stock Doctor Financial Health was only marginal, and the trend was steady. I also saw that in the Stockopedia quality ranking, which was only 41. I think both quality rankings or quality valuations are probably lowered because of the P2P model. So a lot of them are set up for industrial type companies, which Plenti isn't. Not even a normal financial services company, because it's both a lender and a borrower. Well, it's a bit of a variation on that because people are doing it directly. And so I think that's what's affecting the quality ranking. Certainly, I think in the case of the Stockopedia model, but when I drill into the Stock Doctor model, they'll look at things like cash on assets and things like that. So if the company's both sort of, bookending the loan and taking up a margin in the middle, some of those metrics aren't going to work well for it, but it doesn't worry me that they're not. In Stockopedia, the value ranking is 89, which is good, and momentum ranking is 96. So even though the quality ranking was low, the overall rank is 87. And interestingly enough, the F score for this is 7 out of 9. Couldn't quite get my head around Stockopedia saying it's got a high F score, but then giving it a low rank for quality. There's obviously other metrics at play in there. When I had a look, it was looking at things like I can't find it now, but was looking at some of those cash to asset type metrics you'd find in an industrial company. But again, one of the things that they do score it for quality in Stockopedia is return on equity. And this is a capital light business. And so the ROE in Stockopedia was recorded as 71.9%, which is huge. And Stock Doctor have it as 213%. So not sure why they're different, but They're both very big. Probably timing issues there, I say. Perhaps one's doing it for the quarter and one's doing it for the full year. But yeah, very, very large ROE metrics. We don't score it as such, but it's a capital light business, which may be of interest to some of the listeners. What's interesting me is the PE for this company is 2.3 times, and the prop cap is 1.01 times. So we can buy this company at basically its prop cap, that it's the cash it's flying off, and at 2 times, a little over 2 times the earnings for the company. So it's a screaming buy in terms of value. The One thing which sort of I tried to drill into but couldn't get my head around was Stock Doctor is forecasting negative earnings per share growth. And that didn't gel with what the company is saying about growth. If you look at their presentation on their annual results, they were forecasting growth. So not sure why that's happening. And Stock Doctor are taking that valuation or that forecast from one of the brokers who cover the company. There's only one broker covering the company, so I couldn't get access to that broking report. So I can't say why the forecast is for negative earnings per share. I'm a bit suspicious of that, given the growth the company's had over the last 5 years and what they're saying in their presentation. But anyway, it's only one part of our checklist. But we can't score it for growth over PE. Look, perhaps I'm wrong, and that's the reason why it's trading so cheaply. But it doesn't sort of gel with what I'm seeing in other areas. There is an owner-founder on the board. So Daniel Foggo, as I said before, is now on the board. The board holds 24% of shares, most of which are his. It is a company with positive sentiment, but the upturn crossed last year, so we can't say it's a recent upturn in terms of buying. So don't fall for that. And it doesn't have consistently increasing equity. So we can't score it for that. So all in all, 8 out of 15 for quality, or 53%. But as I said, I'm a little bit skeptical of the quality scores coming out of Stock Doctor and Stockopedia. And overall, a QAV score of 0.52, which is high, way up on our buy list, and driven by PropCaf. So yeah, I'll leave it at that. I don't need to worry about trying to ferret out better quality scores for it when it's got a QAV score of 0.52. I think so. Yeah, I think it's very interesting. The risks, I think there's a lot of the businesses based on electric vehicle car loans and solar and battery loans. So any sort of downturn in the EV business, which is happening in the States, according to some of the reports I'm reading, or the removal of green subsidies for solar and batteries by governments, which I don't think is going to happen, but it's a risk when it does. It will hurt the business. The strengths are the capital light model, high ROE. They're expensing tech development costs, which they call out, which is a good thing, I think. So a lot of tech companies will put the cost of their IT development onto their balance sheet and then depreciate it. But these guys are paying for it out of profit, which is good. Owner-founder on the board is great. And I like to look at the new CEO, who's the ex-NAB CIO and had other management roles within NAB and other companies. So certainly a very experienced person coming out of big corporate to run this company. So, yeah, I liked what I saw, but do your own research and have a look.
My only a recollection from NAB back in my Microsoft days is they went 6 years over time frame and triple the budget of trying to roll out a new IT system. Not sure if this CIO was that CIO, but yeah,
possibly.
Never had the impression that any of the big banks in this country were that good at rolling out IT. They're a bit like ASX.
Yeah, well, I think the problem with the big banks, and they will readily admit this, is their legacy systems. They've got, oftentimes they run on Hogan, which is a big bank, kind of all things, a bit like SAP became in the late 90s, 2000s. So, and it's very hard and very costly to get off Hogan. And they've generally taken the approach of patching onto it, which has become expensive to maintain over the years. So, yeah, look, he's probably done the right thing leaving NAB as a CIO and going to a tech company, because it's an incredibly frustrating job, as we talked about with the ANZ pulled pork when the new CEO came in. I think Mail Carnegie, who was in charge of their one platform, has now left the company. For whatever reason, it's not an easy job trying to put a new platform into a big bank in Australia.
No, but that's your job if you're the CIO. No one said it's going to be easy, but taking 6 years longer than you said it was going to, and going 2 or 3 times over budget is, not a good look.
No, it's not.
Yes, it's hard. That's your job. Do the hard things. All right. Well, thank you for that. Let's see if it's a pulled pork curse or a pulled pork blessing.
Well,
time will tell.
Let's see if the check comes through and clears.
Thank you, TK.
Thanks, Cam.